Hi everyone, today we'll be going over accounts May June 2022, paper 2-3, question number 2. This is structured paper 2, which consists 4 questions, 2 of 30 marks and 2 of 15 marks, and we are also given a time limit of 1 hour 30 minutes. And since question number 2 is of 15 marks, we will be attempting to solve this question under 15 minutes. Without any further delay, let's get started. Rakesh prepared his business's end-of-year financial statements on 30 September 2021. So this is his closing date. Now, for the first part of this question, we need to define the following accounting concepts and also give one example of each. The very first accounting concept is matching, and we know that matching concept states that the costs and revenues for the financial period are matched irrespective of actual receipts and payments. First, let's write it down and I will elaborate more on it. So, cost and revenues for the period are matched irrespective of actual receipts and payments. So if we're talking about a financial year, let's talk about the financial year ended on 30 September 2021. And let's say that the salary expenses for this particular year, the total expenses was 60,000, but we only paid 40,000 of it, which means that 20,000 is still yet to be paid, right? So this 20,000 is the outstanding salary, which is not yet paid. So if we're talking about the income statement, we just record our costs and revenues alongside and see which one is the greater one. In this case, the salary that will be recorded in our income statement is actually 60,000 because this is the salary incurred for this particular year, whether it is paid or not. So this is what it means by the matching concept. So for the example, what we can write is an accrual must be made for an expense incurred in the period but not paid for, like the example I just gave. An accrual must be made for an expense incurred in the period but not paid for. Okay, now the second accounting concept is the going concern, and we know that the going concern states that the business should run with the assumption that it will continue trading for the foreseeable future. Let's write it down. The assumption that a business will continue trading for the foreseeable future. And an example of this could be that the non-current assets are valued at net book value rather than the market value, because we know that the business will run forever. That is the assumption, right? So if we record the non-current assets at the market value, then we never know the actual amount of depreciation to be charged for each year in compliance with the going concern concept. So let's write down our example. Non-current assets are valued at net book value rather than the market value. Okay, then the third accounting concept that we have is that of materiality. And we know that this concept states that the information is material if its omission or misstatement could influence the decisions of users of financial statement. Let's write it down and I will elaborate further. So information is material if its omission or misstatement could influence the decisions of users of financial statement. So what this concept means is that the omitted information is material, or whatever omitted information or misrepresentation of information could influence the decisions of users of financial statements, so that should not be done. An example of it would be to classify a low value non-current assets as revenue expenditure. Suppose, let's take an example of a stapler. So stapler does not cost much, right? So, but it is still a non-current asset. It is a kind of a machinery that we use in the office, right? But since it has such a low value, we do not know what depreciation to charge over the years. And the depreciation value would be very low, or we can term it as very insignificant. So we can easily classify a stapler as a revenue expenditure. Let's write it down. Classifying low value non-current assets as revenue expenditure. Alright, this concludes the first part of this question. Now we can move to the second one. We are given additional information. On 30 September 2021, Rakesh decided to write off an irrecoverable debt, of 730 from the account of JD Supplies. So this just means that JD Supplies were unable to pay the amount of 730 to us, and we term that as irrecoverable debt. So this is a kind of loss for our business. Now, the second question asks us to prepare the journal entry in Rakesh's books of account to record the write-off of the irrecoverable debt, and a narrative is not required. So for Rakesh, as I said before, this irrecoverable debt will act as a loss. And we know that losses are always recorded on the debit side in a journal entry. So we will be recording our irrecoverable debt on the debit side. Let's write it down. Irrecoverable debt. And this amounts to 730. And the party giving rise to this irrecoverable debt is JD Supplies. And this is the account that we record in our credit side of the journal entry. So that's JD Supplies. And they are giving the rise to irrecoverable debt amounting to 730. Okay, this concludes our second part of this question. Now we can move to the third one. We are again given additional information. Okay, let's have a look at the question first. We need to prepare the rent receivable account in Rakesh's books of account. And the following details are available for the year ended 30 September 2021. Okay, the first one is that at 1st October 2020, the tenant owed rent 1200. If this is the closing date, 30 September 2021, then 1st October 2020 will be the opening date. So this rent owed by the tenant of 1200 will act as our opening balance. And we're talking about tenant owing rent to us, meaning that this will act as a rent receivable to us, right? And rent receivables is a kind of asset, and assets are always recorded on the debit side in case of a ledger account. So we will record our balance BD, opening balance, on our debit side with the amount of 1200. All right, then the second information we are given is that during the year ended 30 September 2021, the tenant paid rent of 9,000 by bank transfer. We're talking about a rent receivable account, right? And if the tenant pays us the rent, then the value on the rent receivable account will definitely decrease. And this decrement in the value are always recorded on the credit side in case of an asset. So this bank transfer of 9,000 will be recorded on the credit side. So that's bank 9,000. Now for the third part, at 30 September 2021, rent of 11,025 had been received in advance. Okay, so this is an advance, and this will act as advance rent, meaning that we've already received the amount for it, but we are yet to provide the service. So this is a kind of liability to us, right? And we know that the opening balance for liabilities are always recorded on the credit side, but this as we can see, is at the closing date, meaning that this amount of 1125 to be recorded as an opening balance as a liability on the credit side, this should be actually recorded as a closing balance or as a liability on the debit side first. So that would be our closing balance or balance CD amounting to 1125. Okay, then we will state our income statement, and this represents the value that we record in our income statement under the heading of rent, right? In order to figure this amount, this will act as a balancing figure now, which means that we require our total amount first. So the total for credit side is just going to be 9,000, and that is the same for debit side as well. Now, in order to figure out the balancing figure, we just need to subtract these amounts from our total. In this case, that's 9,000 minus 1,200 minus 1,125, which results in 6,675. So now we record this closing balance as an opening balance. That's balance BD with the amount 1,125. So we can actually figure out the amount to be recorded in our income statement in another way. Okay, what we know is that the tenant owed rent 1,200, right? So this should be paid in this particular year. So this payment of 1,200 is actually recorded in this payment made of 9,000, right? So 9,000 was paid in this current year, but the tenant owed rate 1,200. So that's the opening receivables, and opening receivables are always deducted. So that's a negative 1,200. Then we have our closing advance rent, meaning that this is the rent for next year, not this particular year. So this amount should not be included as the rent received in this year's income statement. So we need to deduct that as well. So that's negative 1,125, which again results in 6,675, which is the amount to be recorded in our income statement, like we figured out in our rent receivable account. Okay, so this concludes the third part of this question. Now we can move towards the fourth one. We are again given an additional information. The business owns equipment which cost 24,000 when it was purchased on 1st October 2018. So this is the opening date. And the policy is to provide depreciation at 20% per annum using the reducing balance method. And now we are required to prepare the provision for depreciation of equipment account for the year ended 30 September 2021. We know that provision for depreciation is something that deducts the value of the assets, which means that our opening inventory will be recorded on the credit side. So that's balance brought down. And this opening inventory will actually be the provision for depreciation till the year ended 30 September 2020. Let's figure out the depreciation for this year. So if the opening date is 1st October 2018, then the closing date will be 30 September 2019. So on this year, the depreciation amount will just be cost times our rate, because we do not have any provision for depreciation for this year since the equipment is new. So that's 24,000 times the rate of 20%, which you can write down as 0.20. This gives our depreciation for the year ended 30 September 2019 to be 24,000 times 0.20, which results in 4,800. Now, the next year will be 30 September 2020. For this year, however, this figure of 4,800 will act as the provision for depreciation. So that's 24,000 minus 4,800. This is the net book value, and we require the net book value because we are providing depreciation using the reducing balance method. Then we multiply it with the rate of 20% again. So this gives the depreciation for the year ended 30 September 2020 to be 24,000 minus 4,800 times 0.20, which results in the value of 3,840. Okay. Now this will be the total provision for depreciation to be recorded as an opening balance in our provision for depreciation of equipment account. So that's 4,800 plus 3,840, which gives the total provision for depreciation to be 8,640. Let's record it. Now we will be recording this year's depreciation under the heading of income statement, because we record our depreciation for the year as an expense in the income statement. Okay, so for 30 September 2021, our depreciation is just going to be the cost, 24,000, minus the provision for depreciation till that date, which is 8,640, times the rate, which is 20%. So this gives the depreciation for the year ended 30 September 2021 to be 24,000 minus 8,640 times 0.20, which results in 3,072. Let's record this under the heading of income statement. Alright, now we can figure out our closing balance. If the opening balance is on the credit side, then the closing balance will be on the debit one. Okay, let's figure out the total. That's the sum of these two amounts, 8,640 plus 3,072, which results in the total of 11,712. Same goes for the debit side. And since this is the balancing figure, we need to deduct other amounts from the total. And since there is no other amounts, the total will be the same value as our balancing figure. So that's 11,712. Now we need to record this closing balance as an opening balance for next year. So that's balance brought down with the value 11,712. Alright, this concludes the fourth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.